Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. I'll be your host today. Got Scott with us from Sow Reap Capital. He's out there in the beach, cruising, relaxing. So Scott, first I'm going to start with how's your day going? You doing all right? Doing
Yes,
all
I'm
right
doing
today?
good. I'm doing good.
Yep.
Yes, I am.
All right. So what we're going to talk about today is kind of from an investor standpoint, um, kind of emotional control, strategy, stuff like that. I know Scott's getting some DMs and I think I'm getting some comments like, how do I control myself? How do I handle my emotions? Um, how come this stock XYZ isn't going up? Why why is this not working? Why is this working? A lot of questions that I think should be buttoned down before you enter a stock. And there should be reasons that you own something. There should be reasons that you go into a certain sector. And if you can't name those reasons and you can't name those companies that you think are good and why they're good and who the CEO possibly is, and I don't know if you should just blindly go in and buy them. I know everybody wants the returns. Nobody wants to do the necessary work. But in order to hang on to these things, in order to accumulate, in order to make more money, you have to understand what you own. That'd be kind of like going to a job, not knowing the job at all, but you just want the pay that the job has. Usually, what you have to do is you have to develop your skill set, develop your know-how and how to build whatever product or whatever it is, and eventually you'll start getting paid more money as you become more efficient, et cetera, et cetera. So, Scott, got you on here. How do you prepare to buy a stock or a sector? What do you look at? It doesn't have to be anything in depth. Like basically, how do you prepare to get into something? And then what do you do if something isn't working out for you? And if it's not working out, do you sell it? Do you go to something else? What's kind of your whole approach on buying, holding, and selling a stock?
My starting point, well, pretty much all the time is starting off with the ratio. So this is and so I look for money flow because I think I've learned over time that money flow is probably the most important thing because obviously the sector can be very good fundamentally, but if money's not flowing into it, then obviously your waiting time could be very big. So if I look at CCJ chemical to Dow Jones ratio, for example, and I talk about this all the time, and the reason is because it looks absolutely beautiful. So this is a flow of money from general equities into a chemical corporation or the uranium sector, for example. And you see this across many different charts. So if you go oil divided by Dow Jones ratio, for example, you see it also forming a pretty similar double bottom type of pattern where you've got this very long base, which has started really in 2015, and you've got this really long base. It's breaking out, and it tells me that the money is rotating into the energy sector. So when I look at the charts, though, I'm looking for big moves. I'm not looking for weekly moves. I'm not looking for daily moves. I'm looking for like what's to come in the next years, in the next couple of years, in the next decade, and which is why you always focus, start off with the monthly charts. So if you look at the monthly charts, these are really, really long in duration. So if I look at this chart, for example, it's dating all the way back from 1990 to 2023. So I'm looking for the big move. So what I mean by that is if I'm looking at the last run in used oil, well, the run lasted the entire decade pretty much. So from 1999 to 2008. So that's a decade-long bull market. It's a secular bull market that I want to try and catch. So what am I looking for this time around? Well, I'm looking for pretty much the same thing, which is the run started in 2020. I'm looking for something like that. Obviously, in terms of the path that it's going to take, we don't know what path it's going to take, right? We don't really know what's going to happen next week or next day or anything like that. So the path can look pretty I guess stable. And it can look something like this, right? So it can kind of hug along the general trend and it can look something like this, or the alternative is the path can look something very, very crazy. And it can hang down here for a while, and then do boom like that. So we don't know exactly which path it's going to take. All I know is that the money is rotating. The market conditions are there. What I mean by the market conditions is with the mining sector generally, we've been in a commodities bear market for the last decade, which means the commodities have been very low in prices, which also means it's resulted in massive reduction in production capacities of the miners. So it doesn't matter which commodity you're talking about right now. Obviously, if you look at the oil producers, a lot of them have gone bankrupt over the last decade, right? So obviously our capacity to produce oil for the world has diminished over time. It's same with the copper producers. It's same with iron ore producers. It's same with across all commodities, which is why when you look at the commodity cycle, you're always going to a commodity boom and then a bust. It's a very cyclical sector. And I think it's really just important to understand where the money is within the system. So obviously all the money, if you talk to anyone around you right now, they've all invested in some form, whether it be through a retirement account or their investment accounts. They have exposure to real estate, they have exposure to bonds, and they have exposure to tech, general equities, including the tech sector. What they don't really have exposure to, or great exposures to, is the mining sector. And people are starting to. And if you just look at it. I mean, Peter Lynch always says, look at your wallet, look at where you're spending it, and form your investment decisions based on where your money's going. Well, if you look at others around you now, they're starting to pick up interest in oil. They're starting to notice inflation pick up. They're starting to know that we're in an energy crisis environment. So, and if you also look at our wallet and where it's going now, well, I used to spend a lot of money on, tech, iPhones, getting new phones and things like that, and getting new cars. But now I'm starting to spend a lot more, a higher proportion of my income on energy costs and food costs. And that's where ultimately, in terms of investments, if you wanna kind of predict the future, well, or where the investable money is going to flow into, well, they're the sectors, right? Energy and food, which is why I'm so highly concentrated in those sectors. And obviously, we've got inflation coming. And so Andy and I talk about this quite a lot. We can see very visible inflation. Your value of currency is deteriorating, which means eventually people will have to jump into what's been money for over 5,000 years, which is gold and silver and platinum, as Andy talks about. So for me, the picture is really clear. And it's not really just based on me listening to YouTube channels or anything like that. And if you're just listening to me or Andy and relying on what we say, I strongly encourage that you go way beyond that, because this could be the starting point in terms of what you should be looking at and what areas you could potentially look into. But I think if you really want to grow your own conviction, you really have to go way beyond that and look at the data. And obviously there are things that I talk about with you on this channel, but I mean, the work that goes behind it is way beyond the time we spend recording these sessions, because, and it's not just over a couple of years, it's been like over a decade, right? So I started investing, I think, in 2004. So it's been 18 years, right? So it's 18 years of continuous research into the markets and following the markets and understanding how the markets work. That's enabled me to, I guess, grow the conviction that I need to stay in this bull market, because my conviction is great. So daily movements don't affect me. Weekly movements don't affect me at all. I think I know where the market's going. And so I just sit tight and yeah, not worry about the markets at all. It doesn't affect my emotional well-being.
All right, so this is, I'll tell you my approach to investing and kind of what I do. I start with the ratios. I look at all the ratios across everything, and then I find what's cheap. And that's where I get my confidence to invest, is those ratios. So I know they're cheap. Like if you use the ratios and you get success with the ratios, like let's say 1 or 2 times you get some success, I think you really start to buy into that strategy. And then once you get that buy into the strategy yourself, you can kind of block everyone else out. So I think what's important is to kind of educate yourself on what maybe ratio investing is, and obviously I do that on the website with the question and answer sessions and all this stuff. What that does is it focuses you in, it gets you comfortable with using the ratios, and then you say, okay, I know this is cheap. Now it's just a matter of time. Time can be a couple of years, but it could also be longer than that. And that's what you have to accept, is that time. So you have to get used to buying something that's cheap and stretching your time frame out. I think everyone has a very difficult time stretching time frames. They want everything today, everything now. It doesn't work if it goes down. It's working if it goes up. And in the markets, you can enter something that looks good, but you're only playing with statistical probabilities. You're not playing with for sure 100% outcomes. You don't have control over the outcome. So you're playing with probabilities. You're saying this is a good spot to buy, but it very well could get cut in half again. And that's just part of the game. It's part of the market. It's part of the game. It happens, and it will happen to you. It's happened to me. It's happened to Scott. It's happened to everyone. So the question is, how are you going to handle that? Do you know enough about the company that you just bought to take a 50% haircut in a couple of months? If the answer is yes, and you're going to buy more, then I would buy it and hold on to it. If the answer is, if I take a 50% haircut and I can't hold on to this, then you're probably not buying a company that you should be buying. You don't want it. So that's one thing that I look at. If there's a company, I foam at the mouth. I mean, maybe not literally, but I get really anxious to buy stuff if things go down. And I know it's a good deal. I know it's a good buy. For example, I had platinum. I bought in platinum in 2019. We had the 2020 crash. I was like, oh man, okay, let's go for it, right? So we crashed, and I just loaded in. I was like, this is it. It's below the cost curves. I'm in big. But that's how you do it. What allowed me to do that? Confidence in the ratios. Had nothing to do with technical analysis. Had nothing to do with some other stuff. I also know the cost curves of platinum. So if you're going to buy a precious metal, you need to know what the cost curves are. You need to know what the ratios are. Is it cheap to stocks? Is it cheap to other assets? If it's yes, and we're below the cost curves, that's the least risk time to buy it. That's when you load up. If you don't know those things, what are you going to do? You're going to buy it, don't know anything about it, and then the price goes up and down, and you have no idea what to do. And I agree with that. I wouldn't know what to do if I didn't do any research into it. I would be scared. And the only time I start looking at things, and let's say I buy something cheap, the only time I will sell something, even though it may still be cheap, is if I find a better opportunity somewhere else. If I think this opportunity is so great and it's better than the opportunity I'm in, I'll sell it and take that opportunity. So that's also something that I would do, is buy that opportunity because it's better than what I'm in today. But it doesn't mean that I go chasing just because the price went down or the price goes up or down. It doesn't mean something's, if I get 100% gain, that doesn't mean that the value's gone. It means that you have to be patient, and you have to look at the ratios and make sure that it's still undervalued. And if it is, hold on to it. I'm still holding on to things that are up 20x. And is that a good thing? Is that a bad thing? I don't think it's a bad thing, as long as it's cheap to cash flow and you see future gains out in the future. So that is something that I use. It's ratios and being comfortable with them. And if you're not comfortable with it, you have to dig in and learn it. So when people say, uranium's not working out for me, and you've only been in it for, 6 months or something like that. And I know some people say that, and they're saying, oh, it's gone down. And I know that hurts. I know it feels bad. But there's certain things that you may have to work on. You have to work on not buying or chasing price. And maybe you didn't chase price. Maybe the value is there right now, which it is. And maybe we just have to keep piling into it. Maybe that's something that you have to look at, and you have to get comfortable with the ratios. So when we were talking about the kind of the emotions and the ways that I kind of think before buying a stock, right? And here's something. I know some people think about this. We talk about some stocks on the channel and whatnot. Obviously, it's not supposed to be advice or anything like that. We're just talking back and forth. And we have our convictions, we have our portfolio allocation sizes, all that stuff. And there are certain things like the stars all have to align for me to take a big position. And the stars are ratios, technical analysis, and then the market conditions. If they're pivoting to like from a disinflation to inflationary environment, and you've got a stock that has a good chart pattern, technical chart pattern, and you look at the fundamentals, you dive into the fundamentals, you say, okay, this isn't going to go bankrupt, but you know, it's going to make a lot of money if oil goes up or uranium goes up by $10 a pound or $20 a barrel, whatever it is. Then you make a decision based off the stars aligning. It's not this guy said that it's good, I'm going to make a full-on bet and go big on it. You got to have that conviction. Otherwise, it's, you know, it may or may not work out in your favor. And if it doesn't work out in your favor, you're going to have to figure out what you want to do and the strategies that you want to deploy if you're going to buy more or whatnot. And what you notice with really good investors is they kind of just do nothing for a long time. Like, wait. And then they strike when it's cheap. And sometimes they don't get it right either. And what you have to do is you're going to have to be ready to buy when something's cheaper. When it's 50% down or 60% down, that's when you make your money. You make money by buying things that are cheaper. You don't make money by chasing things and not knowing what the value is and just chasing price. That's where you can get slaughtered because you don't know what's causing the price movements. So when I developed this channel here, what I did is we had the ratios changing. They were bottoming out in commodities against stocks, and commodities were cheap on a 100-year basis. So they basically were never this cheap in history. Does that sound like a opportunity to you? And you could see it bottoming, just riding the bottom. I'm like, that's huge. That's why I started the entire channel. And that's why we've been talking commodities the whole time. And the chart patterns were all in agreement. The money flows were coming around into it. We were seeing some of these things start to kick back up. We saw a capitulation bottom in 2020, and I started the channel in August of 2020 because I saw all that. And I was like, this is a great time to start a channel on commodities because people should be searching commodities in ever greater quantities over the period. My whole channel it's all based off of the ratios. Even this channel is. And I specifically chose finding value, so I wasn't pinned into any, you know, precious metals or uranium or oil and gas. I wanted to talk about everything. It's all finance related stuff and investing. So when you look at this, I really just buy and I hold stuff because I think that over the next 5 or 10 years, things are going to go a lot higher. It's really that easy. It's that simple, that easy. But when you buy something and it doesn't work out for 2 months, 3 months, it doesn't necessarily mean that's a bad stock. For instance, I'll name a company. We talked about it, Castor Maritime. That's gone down some. We're at like $1.20, $1.15, I don't know, whatever it is right now. And I got in with some of my money at $1.75, I think, or $1.65, 75, somewhere in that range. And I'm down in that money. I'm down in that one position. I probably have 2-3% of my portfolio in it, something on the lines of that. And I bought more when it was down. Now it's got cash flow. Now the question is, when is the market going to value this at greater than a PE of 1? They've got cash flow. Now the question is, you know, when are they going to buy back shares? Are they going to get dividends? Are they going to continue to grow? I'm not exactly sure what their next move is, but I know they're making cash. And I think people are scared of the company because they've diluted shares in the past. They bought ships with that money. And the CEO, yeah, he gets paid some money, but so do other CEOs, and they have different pay structures. So I don't think that's a valid concern, at least not for me. It isn't. If it is for you, then definitely don't own it. But you know, that's a company that's gone down, and I have an allocation to it. and I continue to ride it because of the cash flow. I've had other companies where I've purchased oil stocks and
With
made,
Tesla,
yep,
sorry, Andy. With
go for
Tesla, it's not just about cash flow either. It's about real assets in their book, right? So they've
it.
got like $400 million in net assets, and yet they are trading right now at 120 or 110 million market cap.
110 million market
So
cap,
and
25%.
a lot of the $400 million is also just cash as well. They've got like $100 million in cash. They've got, what is the, I don't even remember the figures, but they've effectively got the net asset value on their books is not just like intangible assets. They are real ships and real cash in the bank account. And these are really easy to audit. I mean, there's a for the auditors anyway. I mean, these are really easy things to audit. You just have to look at the cash balance in the cash bank accounts. And also there are, services where you can actually find or spot ships in the ocean, and where, which ports they've landed, and it's got ownership of those ships as well. So it's not like they can commit fraud by misstating their ships or cash balances. So I mean, yeah, for me, it's like, and it's not, Castor isn't the only one that's really cheap in the dry bulk space. I think a Baltic Dry Index is obviously has come down because of certain uncertainty and doubt over China and Chinese lockdown and everything else. But for me, this is really the time to be adding. when the future expectation is really low and the prices are reflecting that, this is when you should when I'd be adding personally. So I think, yeah, when the valuations don't make sense, it's like let's say you've got a car, right, that's worth 100K, right, $100,000, and the market price of it goes down to 20,000, let's say, because that's what Castor is effectively, right? Because now the market's valuing your $100,000 car. It's a $100,000 car. It costs $100,000 to make the car. The market value will eventually have to come back to $100,000. But let's say the market is, pricing the car model at 20,000. Wouldn't you, if you had spare cash and if you're a car enthusiast, knowing that you're going to make, 5x your money, just by holding it, wouldn't you just go out and buy your another car of the same year and make, and just sit on them? Like, it's not about trading. You just buy it, sit on them, and wait for the market to wake up to the valuations. And when it does, when the market is valued so low, what happens is it overshoots. It's a pendulum thing that we talked about, right? When it overshoots to undervaluation to a great degree, then it will have to overshoot in the other direction to the same degree. So whatever is undervalued, and once it picks up momentum, obviously the momentum will chase will attract new buyers into the market, and that will drive valuations far higher than the fair value. And that's what happens with everything, right, in commodities. If you look at the past cycles, just look at the stock prices. They've gone to fair value and way beyond it, because it's the momentum chasers then coming in. What you don't want to be doing is become the momentum chaser. You don't want to be the last herd that piles into a stock just because it's going up. And you can apply that through all time frames. Actually, it could be the hourly time frame, it could be daily time frame, weekly, monthly, yearly. What you don't want to be doing is chase when things are going up. What you want to be doing is accrue near key support levels and just keep accruing. Like, and we've talked about this previously. It's like when you're, I mean, let me just show you the chart of Castor.
It does look good though,
because this is the chart of Castor. It is a main support, and Andy bought some. I was talking to Andy the other day, and he bought it right near the support. So he drew a line there.
I did.
He drew a line.
I bought it $1 something.
Yes. So this is not the time to be panicking, and this is what Andy means by you need to have the conviction to buy more if it was to fall 50%. And that's what kind of Warren Buffett talks about. That's what Peter Lynch talks about. That if you're buying a stock and it falls 50% and you're gonna get scared, you should not be in that stock. Even if you own a stock and it's just going sideways forever and ever, and you're starting to question the thesis of that stock, you should not be owning that stock. I mean, that's not the level of conviction that you want before you buy a stock. You need a far higher conviction than that to hold through the volatile times. Because when you talk about Castor, this is a wild chart, because if you zoom out, let's say you zoom out, right?
Mhm.
And let's say, okay, we can compare it to this period, but let's say you bought it at dollar. I'll show you the difference between buying it at $1.70 and $1.10. On a chart, it looks like nothing, right? Because $1.70 is just around here. So if you told someone when the caster prices were this high that you bought it at $1.70, you could have pretty much said, yeah, you pretty much caught the bottom, right? So when you're talking about a chart with this big a fractal, yes, that is expected. You're gonna have 50% drawdowns. You're gonna have even bigger drawdowns than that potentially, and that's what happened to me with silver stocks when I got into them in 2009. As I said previously, a lot of the stocks did lost 50% within weeks and months after I bought the silver stocks, but very quickly gained. Okay, let me just show you one of the stocks. Wheaton Precious Metals was one of the biggest holdings. So if you look at this stock, Wheaton Precious Metals, I mean, let's say you thought this was nearing the bottom here, right? And you started buying at around $5, right? Which is what I think we started doing with my dad's money. Well, it very quickly fell down to $2.50, which meant you've halved. So basically everything fell. And my dad was panicking because he had no idea, because he was just buying what I was telling him to buy.
Yep.
And he was like calling me every day going, what's happening? What's happening to silver? Well, it fell 50%, but look at what happened afterwards, right? It did 10x from the point at which we bought it. So this is what we mean by you need to have the conviction. Imagine we sold it there. Like, that would have been a horrible investment. I think another stock that we've talked about previously, which I didn't do so well because I sold out too early, and this is by far one of the biggest mistakes you can make in the commodities bull market, is I think with RRL, which is an Australian listed stock. I think I bought it around here. Well, no, hold on. I paid 11 cents for it. So I bought it here. And then it went down to 6 cents. So it almost halved in price too, right? This is back in 2009. And then when I had 50%, when I was about 50% up on the stock, I had sense of relief and I sold out, like, because I was a newbie to the markets, right? And guess what happened after that? It did a 50x after I sold out, pretty much. So
It did a 50x.
I mean, seriously, this is what I mean. Like with Casta, like you're playing around with this zone where it is like little moves in the scheme of things can feel like a massive move, but really what we're doing is just grinding around the bottom. When you try and pick the bottom, it's gonna take longer than other plays, right? Because obviously, if you've got momentum, if it's in a cheater mode and you're just going through a consolidation like this, then obviously the likelihood that it's going to pick up in price sooner is greater than when you try and pick bottoms like this. But I think you just have to really know the game that you're playing. And the only way that we can all achieve that is by really studying history and looking at what's happened historically, being open to all potential outcomes, because everything in life is actually like that, right? Because it's always expectations versus reality. So when your expectation of how someone's going to react, right? So let's say and this is actually a funny story that my brother told me. So he bought my sister-in-law, so his wife, a birthday present. It was a pretty expensive watch. And he was expecting her to be like very, very joyful and very appreciative. But she got very upset that first, she didn't really like the watch. Second, he spent so much money on the watch. And so he got really upset because her reaction wasn't in line with his expectations. And so with the markets, I think it's the same thing. When you're expecting everything to play out really quickly, which is an unrealistic expectation, right? Because it could happen, but it might just as likely not happen. So if your expectation is that everything's going to go up as soon as you buy, of course you're going to be disappointed. Of course you're going to be frustrated. So it's really studying the markets and being open to all potential outcomes over the next day, over the next week, over the next month, over the next couple of years, and really managing that. I think that's hugely important.
Yeah, another thing is what you notice with very successful investors is they really stretch out their time frames. They do not play the short term, they stretch it out. Warren Buffett, that guy stretched it out to like infinity. He's like, I'm never selling anything. He just holds it for basically ever. And that's how he wins. Now, the things to keep in mind here is the pricing of assets is based off the market conditions. And I'll give you an example here real quick. If you want to save money, if you want to be a person who saves a lot of money, you're going to buy boots for your kids one size greater in springtime than buying them right before winter. I mean, that's where all the deals are at. So what we're doing as investors is we're just looking around and we're buying swimsuits in the fall after summer because nobody wants them. You're buying last year's models. You're buying things that are on clearance. You know, you're buying candy after Halloween. I mean, it's that type of mentality. You have to like structure your brain to think that way. You're like, oh man, you bought wrapping paper, Christmas wrapping paper after Christmas. Genius. It's like, that's all I do. It's like ingrained into me. Like the value is there. If you want ultra deep value and you look at life, people all want convenience. They want convenient. They want everything to be convenient. They want everything to be brand new and working great, and they'll pay top premium dollar for it. If you're a value guy, what you're doing is you're digging through garbage, or maybe what is very good. You buy a car that hasn't been in an accident but has a bad engine, so you put a new engine in it. You put the work in, but someone else will pay a bunch of money for it, and you just made it. You know, all of that happen. In stocks and investments, it's the same way. You're buying things when the market conditions are poor for that sector, and you're waiting for the market conditions to turn around to be revalued at a much higher level. Now, the market conditions, we don't have any control over that. We're just investors, and we don't, we're looking at cycles that are on a longer time frame. They're not cycles that happen in a year, like summer, winter, fall, spring, that type of cycle. So we're just extending it out a little bit because the moves are much greater. So if we're playing secular with an S moves that happen over a decade plus, that's where your big money's made. And that's where the time frames match up very well with these very well-known investors. They stretch out the time frames, they get the big move, and they don't play with the small stuff. The small stuff like day trading, they'll just laugh at you if you've got billions of dollars. They're like, you can't build anything in a day. You can't build anything in a week. So even when these guys build their businesses, they don't build visions and structures on daily or monthly timeframes. They build them on a decade, 2 decades, 3 decades. Same with these large investment projects that you see, power transmission lines, all this stuff. It's on longer timeframes. It takes 2 years, 3 years, 4 years, 5 years. They've got these plans, build out plans. They've got strategies all around it. So nothing's going to happen. Well, some things can happen very quickly, and you can get it right, but a lot of it isn't done on a time frame that's measured in months. So if you were to, let's say you don't know anything about the market and you want to make a bunch of money in the market, what is step number 1? Learn ratios. That's what I've learned. It's like, that's number 1. If you learn the ratios, nothing else, you'll still do okay. You just don't know. You got to stretch out your time frames. Step number 2 is you have to learn about risk and reward. Asymmetric, the symmetry, like, do I have a lot of upside here with not much downside? And you got to maximize your risk reward bets. It doesn't mean that you want to take on all the risk in the world. It just means that if you've got a high reward and you can find these super low risk bets, you probably want to look for those and find them. And that's something that I also help on the website as well. I'm not trying to sell the website, but that's what I help with. That's kind of the whole reason I set it up. And then so you've got what sectors that look good. You get a risk rewards. You want to do a strategy of portfolio allocation. You want to strategize on how you want to deploy capital, because things that are less risky, that have really good upside, you want to put more capital to those. Now, there are times in history where the markets get things wrong, where people get overly scared. And the least risky stuff gets priced completely differently, like it's completely mispriced. I think we're in that situation for some of the physical precious metals and stuff. That's where I deploy more money. There's less risk there. So that's kind of how I'm reading it. Now, when you look out forward and you want to make a lot of money, I mean, like billions, if you want to talk like what billionaires kind of do, they're speculating on how the market conditions are going to change in the future and how that will affect asset pricing. So what they're going to do is they're going to look out there and they're going to say, okay, this stuff's cheap, but when will it get expensive? And that's the speculation. That is where you make your money. Is you are seeing a future clearer than everyone else, and then you have markers in the market that are telling you that you're either right or wrong. So the really good investors, what they'll do is they'll say, this is cheap, ratio analysis, whatever they use. This is cheap. This is where it's going. This is how I'm going to measure it. That's what we do in manufacturing even. So we develop a strategy, we get a plan, and then we measure it, and then we measure our progress against that strategy, that strategy against the metrics that we set up. So when you look at the markets, you say, this is what's cheap. How am I going to measure it? And I know you guys want me to tell you how to measure it. One of the things that you could use as a measurement is inventories. Is oil going down? Is the deficit getting worse in the market balances? If the answer is yes, but the price is going against you because of other market condition reasons. For instance, we have gone through a pullback in the markets. The overall stock market is pulling back. What people are going to do is they're going to confuse this as some large recessionary problem. Really, in my opinion, and this is where the difference between a seasoned investor and new investor. The seasoned investor will look at it and say, they're going down because of interest rates. Interest rates price assets. Interest rates going up are going to bring stock markets down. That is a function of what the market does. The stock market is more or less a derivative of the interest rate. So interest rate going up and down is what prices the assets. Going up, goes down. Now, that can bring things with it. It can pull stuff down with it. It can create opportunities for those investors that can tell the difference between value, price, and if your markers are still telling you that you're good, you're good. So your markers are inventory and deficits. If you're eating through your inventories and you're eating through them and eating through them, that's why you hear me with real estate. What do the inventories look like? What does oil inventories look like? What is the inventories in uranium, or what are the market deficits? You hear Scott talk about deficits all the time. If your deficits are drawing down, but the overall markets are still pulling your stuff down with it, people like to say it's coupled to the markets. Well, there's always going to be some coupling. It's not going to fully decouple. It's not going to be inversely correlated. Inversely correlated is the market goes down and this goes up. I don't know if you're going to see that direct comparison. It'll never fully be what you think is decoupled. There's going to be times they couple up, decouple. There's going to be things where the market goes up, but if your stuff goes up 10x that's perfect. That's what we want. And if it goes down and it just ratchets down a little bit, but then you go 10x when it goes back up, that's how the market will move. They're still coupled, but the effects of this coupling are broken. When the overall market goes down 1%, we're not going down 10% anymore. We're going down 1% when the market goes down 1%. We're going 10x when we go up versus the 1% up in the markets. That's what you have to learn. That's what you have to feel. You kind of just have to get used to it. Yeah, and he's pulling up the CCJ to Dow Jones chart, which is a ratio. And that's what you have to learn. You have to get comfortable looking at this stuff. You have to get comfortable with looking at inventories, following this stuff. Once you do that and you get comfortable, you're going to start like mastering things. You're going to see when something's cheap and you're just going to jump like heck on it. And again, I'm going to throw a thing in here. I go over that of what I do. And what you need to do is you need to latch on to somebody who will literally mentor you through this to some degree. What you want to do is you want to see what I'm doing and then ask questions. Well, why'd you buy this stock? Why is this going up? Why is why are you doing this versus other people saying that oil is a bad investment? that the inflation is done, oil's catering, and I would just respond, strategic petroleum reserve releases around the world are suppressing the price. I don't know, to me it's that easy in the way that I look at it. So it's just playing a chess game, and what I'm doing is I'm positioning for the checkmate. But I may have to lose a pawn or two. I may have to lose some chess pieces. It's part of the game. What do you think, Scott? What's your opinions?
Yes, I 100% agree. So I think I've read so many investment books this year that I forget which one it was, but I think it might have been Philip Fisher who said this. So basically the story is none of the stocks, right? Obviously, it's plenty of stocks. There are plenty of stocks out there that can increase or decline by 20-30% in a month, right? So plenty of stocks out there you can find, but none of the businesses change so dramatically to warrant a 20 or 30% movement in a month, right? If you think about it, unless the company is suddenly going through bankruptcy or suddenly thriving, like none of the stocks really deserve a 20 to 30% movement. So basically the message was ignore the stock prices, completely ignore the stock prices. That's not what you should be focusing on, but rather look at the annual reports, rather look at the quarterly reports to see whether the sales and revenue, sales and earnings are in line with your expectations. So that's in case of a normal general equity, where obviously if it's a cash flow business, it's not really so much reliant on the commodity prices, but it's quite stable in terms of their cash flow is largely determined on what the company is doing in terms of making sales. But in case of commodities, exactly right, Andy, what you've talked about. So the question that we should be asking is, do we have short supply or excess supply of commodity that we're talking about, that we're invested in? And obviously with oil, it's very evident that we're drawing down on our supply. So we've got a massive supply deficit. Uranium, we've got a massive supply deficit. With gold and silver, we might not have a massive supply deficit yet, but because of the currency, and this is why we might be a little bit earlier for the precious metals than we are for the oil stocks and energy stocks, is because we are now trying to build in the future demand for precious metals because of the high inflation rate, because investment demand for these precious metals is huge, right? It's a huge component for silver. Silver is used for industrial purposes, but a lot of it is also driven by investment demand. So we're trying to forecast these demand and see, okay, is the supply or deficit greater? And if we have a supply deficit, obviously we know that it's likely to lead to higher prices of that commodity. And so what companies can we position in to prepare ourselves for the rising commodity price? So I think really the best thing to do is, and I think I've said this many times, but best thing to do is not really focused on daily movements. Don't even look at the share prices and really just focus on the long term, because the ultimate destination that we want to get to is like way far, right? So you're almost looking into, the sunrise in the morning over the horizon, and that's the destination that we want to get to. Yet we are so focused on what's in front of us. Like we're so focused on just looking at the waves and the sprinkles of water in front of us that we're not focused on the sun that's rising, and that's where we want to get to. So I think just take a long-term view. That is, and as Andy said, we are completely focusing on the wrong thing if we're looking at the price movement every day. We need to be looking at the fundamental developments. What's happening? Is the money flowing out of general equities and bonds? Tick. Is the money potentially not going in as much as we saw historically into real estate because of the rising interest rates? Tick. Where can money flow, right? So we've got unprecedented amount of cash on the sideline. So where can that money flow in an environment where we have energy crisis and food crisis? Well, the answer is pretty obvious. The money is going to flow right into the energy sector. And agriculture goods as well. So, and fertilizers potentially. So it's being focused on the right thing that really matters. I think that will keep you insane. That will keep you on path. And I think that's just generally in life as well. If you are for example focusing on every conversation that you have throughout the day, or every mean thing that people are saying to you, or everything that's little things that are going wrong in your life, obviously, I mean, I can give you an example. So I love my cars, and you know, when I bought my car, the new car got scratched a little bit. You know, I was wasting all my emotional energy on that. But in the scheme of things, I was focused on the wrong thing, because by focusing on that little scratch on the car, which doesn't really affect my life at all, you know, you're missing out on the opportunity to enjoy your life, right? I'm missing out on the opportunity to, you know, get around with the family, have a lot of laughter, you know, enjoy our time with the family, and enjoy going out, enjoy driving the car, because that's why I got it. You're missing out on all those opportunities. So when you're focused on daily movements in the chart, it's not like it's like focusing on that scratch on the car. You're completely taking yourself away from enjoying life. And that's not the place you want to be. We want to ultimately invest in this because we do want to enjoy life in the future. So why are we wasting away focused on little scratch on the car while we can go for a massive drive, because that's kind of what we're doing, right? We're driving towards this massive destination. Why you worry about the little scratch on the side of your car? We should really be looking ahead. Really also just be focusing on appreciating our lives, I think, being grateful. Um, and I think that's just such an easy mindset to flip over, because I think there are so many things in life that we could be thankful for, but we're not. And when you start complaining, which is honestly, I did that for the last couple of weeks, because I've just had so much work on at work, and I did start complaining a little bit, and I was saying, oh, you know, work is getting tough, but you know what? It's not that tough. It's not that tough if you think about it. I mean, if you think about the humans 5,000 years ago, they had to they had to go out there, go out and, you know, light up their own fire, light up their own heating. They had to go hunting, catch what they're gonna eat, and skin what they're gonna eat, and do all those things. I don't have to do any of that. I can just sit in front of my computer and type away, and I can still feed myself. And it's a flip in mind. So if you're not really focused on the right things in your life, which is what should we be grateful for? What can we be grateful for? But rather focused on little things to complain about. And if you go on a mode, I mean, I see a lot of comments now on Andy's channel and my channel as well, with a lot of negativity. If you're focused on those things, I really do feel sorry for those people, because you're completely focusing on the wrong aspects of your life. If you are, and the reason why I say that is, obviously Andy and I don't really get affected by those comments, but if you're doing that to yourself, and if you have that negative mind in yourself, that you've got to express it to someone else, that you're trying to put it on someone else, obviously you're not feeling great. And I really do feel sorry for you. And really, I would encourage you to just flip your mind and just start writing down the things that you could be grateful for. I mean, that's what I really try to focus on. Obviously, I'm not perfect, and I do sometimes get a little bit negative. I do complain sometimes, but I think I always try and bring myself back to what I can be grateful for, because we've been given so much. We've been given so much, and also recognizing things that aren't really within your control, right? Because there are lots of things in life that we can't be in control over. And sometimes we think that it's us that's doing it. But in terms of our key abilities and what's so important for us, none of it we've determined ourselves. None of it. So including my name, I didn't really come up with my name. I didn't really come up with who I was born under, my parents. I didn't really pick out which country I was born in, right? You know, I could have just as easily been in a developing part of the world, right? But I was fortunate enough to be raised in an environment like this, which means I should be grateful for all the things that I'm given, literally. So yeah, just be grateful. I think that's probably my best answer.
You're getting deep here, Scott. That's why I buy cars with scratches on it, so I can scratch it more. with autocross cones or something on it, you know? That's why I don't buy new cars. Literally. And that's where the value is too, is just buying ones that are cheap and having fun with it and letting it rip. But Yeah, I think that's all I've got, Scott. I've got kids here. They're going all crazy right now. Gosh. But if you guys like the content, guys, give us a thumb up. Throw something in the comments section. Are you grateful for what you got? Put down I'm grateful or I'm not grateful, whatever you want. And we'll end it there. So thanks for coming on, Scott. Really appreciate it. And we'll
Thanks,
catch
Andy.
everybody next time.
See
Thank
you,
you.
everyone. Bye.